All right. 5:30 p.m. on the East Coast, and it's Tuesday. So you know Michael, what does that mean? Tell everybody. What are we doing?
We're doing a show called What Are Your Thoughts?
What are your thoughts? That's right.
Can I say something I should just, now that you mentioned 5:30?
I want you to.
Here's my idea. We're going to change the start time to 5 o'clock. There's no reason to start at 5:30.
Like for the summer? Like spring, summer? Change?
Just for life. It's too much.
For life.
It's too late.
It's too late in the day.
Sorry.
Right.
Just decided we're doing that.
Why is it 5? Why do we do this at 5:30?
It's just what we started, but were we giving people a chance to get home? Everyone's home.
Hear me out. 10 p.m. All right. I want to first of all, shout out to the whole pound. Everybody's here tonight, and I've been told that I have a habit of saying hello to the same 6 or 7 people, and that's true. So I want to just say hello to all the day ones. If I don't get to you individually, I see you and I love you. But we have some new people I want to say hello to tonight, and those include Dr. Doc 88, Chad Bell, Red Pie, Brian Grill, and Jared King.
Dr. Doc 88, who I love, definitely has an AOL email address.
I hope so. Ben Souls is here. Pam Hill is here. What's up, Pam? Bob Sacamano, good to see you, my man. Rachel's in the chat. Nicole's in the chat. The whole gang, and we love you all. All right. We have a lot to do tonight, and I just wanted to start with something that's not on the agenda. Just thought this was interesting. Some signs that you're talking to somebody that's super rich. Tell me if you agree with any of these really quickly. They wear nice clothing with no brand identification. Like you never see like a really wealthy person with a giant LV on a sweater.
Yeah, it's like a t-shirt. It's like a white t-shirt that you know is $300.
Yeah. You're right, but it's nondescript, no labels.
Yeah.
They're quiet when the discussion is about cost of living pressures. They'll deflect questions from themselves or nudge the conversation into a different. Yeah, they don't want to talk about that shit. They know they can't relate. Casually having expensive hobbies like sailing. Yes. especially if they're landlocked.
Sailing.
There's
no sailors around here.
Or they live in Southern California and they're really into skiing. It's like that's rich people shit for sure.
Where are you getting this list from?
A news article. They have a certain ease with which they move about the world that you have to see to understand. Oh yeah, I know all about that shit. Not personally, but I've seen minimalist homes. There's a whole thing. All right.
I actually just got an email from like a NetJet type competitor.
Who's that?
I don't know.
Okay. What do you want me to do with it? You're asking me to pay for a NetJet subscription? All right. Are we going into content now? What do we got?
What do we got? Let's go. What are we doing?
All right. I'm first.
It's 5:34.
I wrote about this lending shock story yesterday. I really think that, we talked about last week commercial real estate related loans and lending being the next shoe to drop. The bridge between here and there, though, is the banks tightening credit. And I think that this is an area that we really haven't had to think much about. And what's a smirk on your face? Do you agree or disagree?
On today's Animal Spirits, Ben and I were like, when something's bad happened, everyone always talks about the next shoe to drop.
Well, this is in between now and the next shoe. That is the next real shoe. But I think it's like one of these like very obvious things that's staring us right in the face. So maybe it's too obvious to actually come true.
But to that point, and we're going to talk about this later, if the shoe doesn't drop, like if there's no hard landing with the shoe, what do we call it?
I think it did drop, though. Like I think this particular part of the shoe is already on the floor.
The heel. Okay, let's go.
Let's do this chart really quickly, and let me just explain what we're looking at. This is overall commercial and industrial loans, and this is all banks. So large, small, every region in the country. This is just to give you a sense of how big this business is. It's about $2.8 trillion worth of C&I loans out in the economy. We talked about this a little bit last week, but C&I loan could either be a lump sum or it could be a revolver. It's just any form of credit available to regular businesses that cannot tap. All right, John Chartoff, that cannot tap Wall Street. So a typical business with 100 employees, 500 employees, they're not selling bonds. They can't do a secondary issue of stock. When they need money, they go to the bank. And let's do this next chart. This is the net percent of banks already reporting tighter standards for C&I loans. So this is about 50%. And any time that we've gotten here in recent memory, it's either been during a recession or in the run-up to a recession. So it's pretty obvious chart off, and that comes to us from Bank of America. And Bank of America's economists went and looked at this, and they noted a couple of things. And the first thing is that when you have a financial shock or a banking shock, it doesn't just wear off. Even if the FDIC steps in, closes the bank, fixes things, there's a lingering effect, and it doesn't just go away. They note, quote, tighter standards on consumer lending reduce consumer loans by a cumulative 10% over about 10 quarters. We also find fairly short lags between tightening in standards and economic outcomes. Effects tend to appear within 2 to 3 quarters. In addition, shocks to lending standards for C&I and consumer loans are very persistent and, generally speaking, do not wear off. So the clock is now ticking. We had the banking shock. It's unlikely that banks in a week or 2 weeks from now are all of a sudden going to start loosening their lending standards and getting risk on. I can't picture it. So I feel like this part of the shoe is already on the floor. What are your thoughts?
If there is demand for loans, they will make them. The conditions of the loans will obviously be tighter than they were in the past.
Well,
but I agree.
Because if the conditions are tighter, then that will reduce demand for loans.
But this is not a great chart.
No,
so
it's not.
Neil Kashkari said, talking about the banking sector, whether we're close to a recession, he said it definitely brings us closer. What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. This isn't really a credit crunch, it's a liquidity crunch that's being caused weirdly by the safest instruments in the world. It's a very odd situation.
But now it is a credit crunch because if you've got this huge uptick in lending standards, then de facto it becomes a credit crunch. It's not like there's money available for the things that there was even 3 months ago. Things have changed. I don't think you could rescue. I don't think you could just have a simultaneous rescue of Credit Suisse and Silicon Valley Bank, have the wind down of the forced closure of Signature, and the near death of First Republic, and like be back to game on in a week. It seems really improbable to me. Even if we think we've seen the worst, and frankly, it wasn't that bad. We didn't have anything really catastrophic that the government couldn't handle. Still, I think it changes the mentality at every bank in America. So
yeah, I don't disagree with you at all. I think it's a little bit early to call it a credit crunch. We'll see.
Right. I think the question is, can we avoid a real credit crunch? Like the type of credit crunch where things completely close down and freeze out. I don't think that anyone's really calling for that. Like a 2008 style credit crunch is not the thing that people are worried about.
Well, one of the reasons why banks might be less willing to lend is because they are, sorry, let me turn my do not disturb on. They are going to have to pay a higher rate for deposits than they're used to. Just thinking about we're going to get to this in a second, but money market funds have taken in a ton of cash. Goldman, $52 billion. I think this is in last week. JP Morgan, $46 billion. Fidelity, $37 billion. So if money is coming out of, matter of fact,
where that's coming out of people's savings, bank savings accounts into money market.
So this will bleed into my topic. Our bank's screwed.
That's okay. Keep it rolling.
All right, let's throw up some charts to show what we're talking about. John, chart on, please. We've showed this in the past. Next one, if you don't mind. We've shown this in the past. What we're looking at is a Fed funds rate, which is the green line. And the yellow line, which is overlapped with the other line that you can't see, is the national average interest rate on checking account and savings account. There is a gigantic discrepancy And so Torsten Slack from Apollo said the spread between Fed funds rate and interest rate on checking accounts is the fundamental reason why money is being moved out of bank deposits. Highly unusual compared to previous banking crises where the source of instability has typically been credit losses. So that's not what we're seeing here. The next chart shows $600 billion worth of deposits leaving the banking sector since the Fed began to raise interest rates. And you could see that really picking up into money market funds over the last, I don't know, a couple of weeks. Next chart, please. And Josh, I'll be done with the charts in a second.
These are great.
This is the next one is from Nicholas. He says this is Google search for money market funds. This chart tells you pretty much all you need to know regarding what U.S. depositors are thinking about in terms of alternative places to park their cash. And that's the story. That is the story.
Can we go back to that difference between Fed funds rate? Yeah. So leave this up. So there's an article about Schwab. Something about like their $7 trillion empire built on low rates is showing cracks. I forget if it's Barron's or Bloomberg. The gist of the article is not, oh no, Schwab is in big trouble. The gist of the article is like the business model is now what people are like. People aren't selling Charles Schwab equity because they think like it's First Republic or it's Silicon Valley Bank. This is the reason why they're selling these types of stocks, because these are companies that have gotten through this ultra low rate, zero interest rate period, basically by hoarding most of the yield as part of their own revenue. Now they're doing that to offset free services that they're giving people. And that's like free trading, for example. So that's the business model. And there's nothing controversial about it. The problem is it doesn't work as well when you got the guy across the street advertising 5% yields. And that's really what. So you're going to see money flying into money market funds so long as yields stay as high as they've been. And companies that have had like a zero cost deposit base are going to have to figure something else out. And that something else might be taking a hit to earnings because it's just not as profitable anymore.
So speaking of earnings, Warren Pies has this great chart showing that the financial sector forward earnings estimates have collapsed. This is that. So this is that. So this is one of the big reasons why Schwab got absolutely murdered, because is it 60% of their money is made off of cash? And unfortunately, another table from Nicholas is showing that financials are the second biggest contributor to earnings in the S&P 500.
Yeah.
Hard to see how this doesn't weigh on the market one way or the other.
Yeah, we were preparing for my appearance today on Halftime Report, and Sean put a whole bunch of interesting stuff about what's been working this year versus what's not. It's incredible the degree to which January through March of 2023 is a complete reversal of January through March 2022.
Because value's not working. Financials, energy. Energy is coming back, but
it's through the looking glass. It's
incredible. Large cap tech, right? It's large cap tech.
Right. Financials and energy are the worst this year. They were the best last year. Mm-hmm. And, this is just all about how quickly the economic expectations have been flipped on their head. And, the story of banks make more money as rates go up, typically, but we haven't seen them go up this quickly, and a lot of them have business models that weren't ready for this.
And
the yield balance sheets,
and the yield curve is still deeply inverted.
Right.
So if they're going to have to pay a higher rate on short-term deposits than the loans that they're making longer, it's not great. It's not great. Let's talk about Credit Suisse for a sec. This is just insane. This is from Mark Rubenstein. We're looking at the last 10 years. So on the left is their net revenues. Mark says in the past 10 years, Credit Suisse earned around $230 billion in revenue. Around $110 billion was paid out to employees as compensation and benefits. Another $100 was consumed by other expenses. After credit losses of $7 billion, that left $13 billion to be shared between investors and the tax person. The tax person took it all. Net of tax, Credit Suisse lost money in 5 of the last 10 years, and in aggregate, it lost $3.4 billion over that period. Just really stunning incompetence.
So it's like a machine that just like pays employees, pays taxes, and
loses shareholders' money.
And loses shareholder money every year. It's almost
incredible.
It's almost a pointless exercise when you think about it. This is all hiding in plain sight. This didn't suddenly go bad. This was bad with interest rates at 0. It's bad with interest rates at 4%. it would be bad at 8% or 2%. It's just bad.
I know this is not good, but I was talking with Ben today that the banks, the Fed could bail themselves out if they want to get rid of these losses that these banks have in their treasury. Just lower interest rates and make them whole. Boom, problem solved.
They don't want to do that. I want to go through this from Peter Bookvar. This is the cost of what's going on in the banking system with all the bad loan risks, the commercial real estate stuff, et cetera. Like leaving that out, just focus purely on the profit hit that everyone's worried about for the banking sector. Like no catastrophe, just like what's going on right now. Okay, this is Peter. I want to put numbers to the inevitable profit hit for banks. Let's dive into the profit hit from a rise in deposit rates paid. So let's assume all of these banks have to raise their deposit rates, keep deposits in-house.
So that people don't live to money markets.
Yeah. All right, quote, let's assume that in total banks raise deposit rates by 200 basis points. Some more, some less, and I'm not sure where checking account rates go. On a pile of $18 trillion of bank deposits, that is a rise in costs of $360 billion. For perspective, according to the FDIC, net income for the U.S. banking system, which includes 4,700 commercial banks and savings institutions insured by the FDIC, was $263 billion in 2022. That compares with $233 billion in 2019. So the rise in costs of $360 billion could literally swamp, and then some, an entire year's worth of net income for the whole U.S. banking system just to keep deposits in-house. Now, that's theoretical. In practice, some banks would be more competitive than others, and a lot of that would come out in the wash. But still.
And guess what? What about finding other ways to make money? They're going to get their piece. They always do.
What, banks finding other ways to make money?
Yeah. I mean, I know this is big. I'm not trying to minimize it, but they're going to get you in other ways.
Well, one of the problems that we have is the consumer financial protection, whatever. Like, you can't just like start nailing people for checking accounts and stuff. Like, there has to be.
I went to the bank today to get a new checkbook. $100. I think it was. No, I'm sorry. It was $25. Not 100. Yeah, I think it was $25 for 100 checks. Is that right?
Right.
Sounds like a lot.
But overdraft and all of these things, banks have been making money there, so I don't think they could charge more. I don't think they could. I don't think they could add to that. I got a letter in the mail from SoFi, which tells you super tech, super fintech, cutting edge. I got literally physical mail, and they wanted me to take out a loan, and the teaser rate was like 7.89%.
Ooh.
It's pretty tempting. I don't need the money for anything really, so I didn't do it.
Not to brag. A couple of weeks ago, I made a throwaway comment like Jamie Dimon deserves every dollar that he gets. He's one of the highest paid executives in the country, or at least certainly in the banking sector. He's a billionaire from being the CEO. Somebody flagged this on LinkedIn, and I actually remember listening to him say this. I think it was in the last earnings call, or maybe 2 ago. Somebody asked him about their cash management, and he said, "Can I just take that? We're not going to do anything to protect the net interest income. We have $300 billion of cash we can invest today, and that becomes $400 billion. We're not going to invest in stuff making 50, 60, or 70 bips, so we get a teeny little bit more of NII. We're going to make long-term decisions for the company, and if your NII in the end gets squeegeed a little bit, so be it. But we don't want to be in a position where we lose a lot of money because we made investments in 5 or 10-year securities, which you'll lose a lot if rates go up, so we're not protecting NII."
Such a
Pretty
gangster.
good.
Such a
Pretty
gangster.
good.
He just understands the big picture and then directs that understanding downward so that the people in his bank in charge of this kind of shit don't do dumb things.
Now, it's
but you only know they're dumb in hindsight, but he knows they're dumb in advance. It's
also fair to say that JP Morgan's income and flexibility is gargantuan compared to Silicon Valley Bank. You know what I mean? Like, maybe if he was there, he would have squeezed it. Whatever. Point is, pretty good call. Pretty good call.
Well, a major difference between JP Morgan and Silicon Valley Bank is that JP Morgan has been going through stress tests as per Dodd-Frank every year for 12 years is number one. Number two, you don't have that monoculture of users or clients, whatever you want to call it. And then, yeah, to your other point, number 3, they have a lot of different ways of making money. This is not a one-trick pony. It's J.P. Morgan Chase. So they probably have 1,000 different product lines that we're not even thinking of under all of these subheaders and sub-businesses, and that becomes important. So some businesses go bad, but hopefully the other ones are okay. I want to talk about the FDIC, and not to embarrass anyone, but in particular, but just generally speaking, when you hear civilians talk about the banking system or react to what they're reading on Facebook about Silicon Valley Bank, etc., are you like cringing a little bit for people, or are you not really paying attention to what people are saying?
I'm not, but
I've had
also
a very hard time this spring.
Why?
It's just
you get
all
mad. You get mad that people don't understand the intricacies of the FDIC.
I don't really get mad, and I'm not an expert in the banking system either. But like, it's incredible how stupid people are.
Why?
How little.
All right, give me. What do you mean?
People are like willing to make a comment, like at a dinner, for example, or in a car with other people in it, or at a bar or at a party or anywhere that I am. People are willing to be like, "Oh yeah, the whole thing's going down the tubes," or the FDIC is a scam, or like any tossed off remark like that. I don't get mad. I'm just like, you're so dumb. Like I say to myself, you're extremely a dumb person. So
it's all the house of cards. It's all the house of cards. Oh, did you know that if everyone took their money out of a bank, the bank wouldn't have it?
Yeah, no FDIC's a Ponzi. This one I was like, oh, it is? How?
Well, I don't think most people
it's
know.
Never there when you need it.
So the FDIC, the FDIC is going to take a $20 billion hit to facilitate the sale of Silicon Valley Bank. Guess who pays into the FDIC coffer?
The fucking banks.
The banks.
The fucking dummies.
It's
Hold
not
on.
Taxpayers.
Dude.
They're not dummies. How would a civilian know that?
I can't say this to their faces, but their assumption is, oh, it's gonna cost us, it's gonna jack up. Like it might actually, because banks might have to charge us more money to pay.
Yeah, probably will.
So that's actually not the dumb part. The dumb part is it's a scam. It's never there when you need it. Couple of things on this. We have almost no capable institutions left in this country. Like almost zero. The FDIC, and I said this at the outset of this crisis, it's actually one of the most competent parts of government. It works. It's always worked. It's non-political. The people involved are not on Twitter. They're not famous. And
that's a good point.
It's an amazing point. Thank you so much. No, I really mean this. This is the kind of thing where any minute now, Trump could go, the FDIC is run by Jews, and completely destroy this institution's trust. Or Biden could come out and say, there's not enough, people of this particular minority group involved in the FDIC. And then the whole thing will get thrown out the window because it'll become a whole brawl. But for right now, people have confidence in the FDIC, and they should. It's about 6,300 people working there. The annual budget is only $3.1 billion, which for a government institution might as well be zero. It was born in June of 1933, so it's turning 90 years old this summer. And its creation was part of the Glass-Steagall Act. And when they overrode the Glass-Steagall Act at the end of Clinton era, this part didn't get touched. They left it alone. It works as advertised. And one of the main things that I think people are getting wrong now is they're screaming over the possibility that the FDIC limit for insurance might go up. Do you have any particular issues with this thing going to $500,000 or $1 million?
No, 250 is arbitrary. I don't have a problem with that at all.
So, John, throw this up. Fun fact. Only 6 months after the creation of the FDIC, government leaders realized the initial $2,500 limit for insurance was not enough. So they actually doubled it in July of 1934. So at the outset, they were playing with the number, right? And they've doubled it several times. They went from 10 to 20. They went from 20 to 40, 40 to 100. And if you look at the dates here a lot of these FDIC limit raises have coincided with
Crises.
really bad stuff happening in financial markets.
It's interesting that the last time they raised it was 2008, so it's been a minute. Yeah, let's raise it.
It's not interesting. It's actually poignant because they had to do it at that moment because there was zero trust in the banking system. It was like the only thing they could do was raise it. And they haven't raised it since. And actually, historically, about 14 or 15 years is when they do the next limit update anyway. So if they were going to do it, this would be a very good reason to do it. It doesn't mean guarantee every dollar, every bank, but if it's an arbitrary limit anyway, make it arbitrarily higher.
I like it. This is getting back to SVB for a second. So Tim Moreos yesterday tweeted the 10 largest deposits accounts at SVB held $13.3 billion. $13.3 billion. So Krishna Mamani quote tweeted and said, "This is an astounding amount with Circle at $3.3 billion. By the way, the FDIC, the banks bailed out stablecoins, $3.3 billion, which is kind of hilarious. Yeah. Roku at $500 million. That leaves a lot of unaccounted for large deposits. A public company would have to disclose it. So it has to be private companies, but more likely the VCs themselves and personal accounts. That's insane. So what if these VCs personally had, I don't know, pick a number, $700 million at the bank, and for reasons why, I'm sure they were getting ludicrously favorable loans and treatment and massages and whatever.
Yeah, they were getting flown out to the Catalina wine mixer for sure.
Yeah.
I want to point out the FDIC walked into Silicon Valley Bank, immediately got the house in order, stopped the bleeding, and within 10 days sold the bank to First Citizens. And First Citizens is very important here. It's a North Carolina-based regional bank. They actually made a name for themselves during 2008. I think they rescued 9 other banks in the last 15 years. They have become a go-to player for the FDIC in situations like this, where the headline that Citigroup is swallowing up another bank is a little bit unpalatable. So First Citizens kind of has this cottage industry of being called into these situations and rescuing other regionals. They're getting $72 billion worth of Silicon Valley Bank loans at a discount of $16.5 billion.
And the market liked the deal for that bank, right? The stock.
Yes. They're getting $90 billion in securities and other assets that were owned by SVB. That's the part that will remain in receivership for disposition. So in other words, the FDIC holds on to the securities and the other assets. Some of those securities are bonds. They mature. That money is used by the FDIC to pay off the depositors. In the meanwhile, the active loans that need to be serviced, et cetera, First Citizens takes over that business. The FDIC, as you mentioned, they say the cost will be about $20 billion. They don't know for sure. But again, far from catastrophic.
By the way,
truly.
You make a good point that the headline risk of Citigroup or Morgan Stanley taking over, that would have made it a lot worse.
Well, so I think that's why Citizens Bank has this inside track. I think they have 17 or something branches. It's not big. So this is really gonna rev that company up. This is a pretty big bank to be taking over.
But my point
is,
imagine
they also get the RIA.
Right. They did. Imagine a giant bank buying this. Imagine Morgan buying SVB that was bailed out by the FDIC, which wasn't bailed out by taxpayer dollars, but would have got spun that way to make the rich richer, to make Morgan buy it at a discount for pennies on the dollar. It would have been horrible.
Let's finish with this. Some charts from Ed Yardeni. This is the I don't want to say the bull case. Ed Yardeni lays out the case where things don't completely melt down. And I think one of the things he's talking about is how quickly the market has already adjusted.
It's insane. The market discounts it in 2 seconds.
All right. So this is S&P 500 regional banks stock price index. Look how quickly this priced in what was going on. Next chart.
Wait, Josh, hold on. To this point, so Mark Dow tweeted this, and it's such a great point. Everyone is sure this recent banking turbulence is going to cause a significant contraction in credit. It's likely to cause a contraction in credit, but there's no way we know how much. And I'm guessing people are more likely to overestimate it than underestimate it.
That sounds fair. I might be in that camp. That's absolutely fair. Chart back on. This is Ed. There could be mergers and acquisitions among the regional banks to avert disintermediation. Wow. They will have to raise their deposit rates, which will squeeze their profitability. That could force many of them to consolidate. In any event, industry analysts who cover the S&P 500 regionals responded quickly to the crisis. During the March 16th week, they cut their 23 and 24 revenues per share estimates by 7% and 7.6%, respectively. They reduced their earnings per share for those years by 6.3 and 7%. Investors slashed the S&P Regional Bank stock price by 25.8%. And now this new chart is the forward PE. Just above 10 during February, now a record low of 6.3 times forward earnings. Next chart, please.
But wait, hold on, Josh. Let me just jump in real quick. Would you be surprised? Would you be surprised if the minute everyone is saying banks are uninvestable, they go on? I'm not saying that they're going to bottom and turn around and have a sick run, but that they actually over deliver returns over the next couple of years just because they've been de-risked to the extent that they have in that chart.
You know what?
I'm not betting on that. I'm just asking. It's not possible.
That would happen if you get this big consolidation wave and a lot of costs taken out. But that process takes quarters and quarters, not weeks and months.
Yeah.
The thing is, I don't know that will necessarily happen because there might not have been enough damage to the industry. Like, in other words, the reason we have 4 airlines in this country is because 6 of them went bankrupt. That didn't happen with the regionals. We had 2 players, one player disappear, another player merge with someone else. It's not quite a scenario where you've had the sector bombed out enough to be like that ballsy as a contrarian. But I get your point.
So Silvergate is gone. Signature and SVB were
Silvergate was not even a regional anymore. It was a freak show. Let's do this last chart. This is FDIC. The fund itself had a balance of $128 billion at the end of last year. So they're not tracking this weekly or whatever. But that's a lot of money to play with. So if in fact there are 5 more Silicon Valleys, which it doesn't appear there are, especially if people calm down and stop running away from banks, plenty that could be handled. So I want to tip my cap to the FDIC. They actually function. They actually go about their business apolitically and very, very potently and get things done. And thank God they're here. And people should stop making offhanded remarks like it's a Ponzi or whatever. You're really showing us how dumb you are. All right. Next.
Wait, hold on. One less thing. Oh, they're probably gonna raise the amount. Probably, I'm guessing they would raise the amount by which banks pay into that fund. Doesn't
That's
that
part
make
of
sense?
the profitability hit. Yeah,
exactly. Raise the limit. Banks pay more. Let's do it.
Right.
All right. Let's talk about debt loads. I'm going to talk over this chart. So, John, please chart on. This is from the Journal. Companies with the highest ratings have sold $60 billion worth of new bonds this month, compared with March's 5-year average of $180 billion. The risky corporations have found it even harder, not surprising. Those companies have raised $5 billion worth of junk bonds versus the 5-year average of $24 billion. So bond issuance is much lighter now than it has been in previous Marches. However, I'm here for some context. Chart off, please. Last week, we spoke about the amount of fixed debt and the amount of bonds that were issued in 2021 as companies just gorged on all the free debt. So, Exhibit 17, please. More than 75% of U.S. corporate debt in the S&P 500 is long-term fixed. Another 12 of it is short-term fixed.
Thank God.
Seriously. So short-term floating, it's less than 4%. And yeah, you're right. These companies that are sucking the junk teat are in big trouble.
Yeah, and we'll hear about them. It'll be this kind of rolling thing that, I don't think it's the kind of thing that happens all at once. It'll be like all of a sudden you'll see an equity price at $2-3. You'll be like, oh man, what's going on there? It'll be one of these companies that didn't have their balance sheet secured in the low rate era, whether because they couldn't or they didn't know better.
One more thing. I know that credit spreads don't tell you everything about what's going on in the economy, but they're a pretty good gauge. Like if there's fear, if shit is fucked up, you'll see it in credit spreads. You're not seeing it yet. So first chart, this is investment grade, and this is the spread that companies pay over the treasury. And again, you wouldn't know that anything bad is happening right now. The next chart is junk, which would be even more susceptible to things going awry in the economy, and we're not seeing it. So I'm not saying everything's hunky dory, but it's those are facts. Those are the spreads.
Yeah,
That's not an opinion.
I think that's right, and this is the kind of thing that people are going to be keeping a close eye on again. And it's been a long time since anyone's really had to, really since the COVID era where everything was topsy turvy. Now it's going to be more case by case.
But Josh, I think to your point about giving credit to the FDIC, if they did not do what they did, you know where their spreads would be? Way higher.
No,
they contained the
right.
crisis.
We would have 20 regional banks, like literally begging for a bailout or getting swallowed up by Bank of America. Is that in anyone's best interest? So for obvious reasons. And now, by the way, they testified today in front of the Senate Banking Committee, and they're going to testify tomorrow in the House of Representatives. And the guy from the FDIC, the gist of what he was trying to say is, I want to remind everyone, the investors lost money. Like if you were an investor in Silicon Valley Bank,
all
in
of
the
it.
bonds, in the stock, you lost all your money.
No, not bonds.
Excuse me, the equity and the executives. They lost everything pretty much. So this is not the same as 2008 where there's a cash infusion and the same people who are running it just keep going. That is the opposite of what's going on here. And I thought it was good that was pointed out for the senators, most of whom probably needed to hear that in plain English so that they can answer their constituents. I want to talk about Binance. We don't have to spend a lot of time on this. The CFTC suing Binance seems like a big deal to me.
What about it was the big deal?
Well, they're alleging something that everyone knew and was in plain sight, but they actually have the receipts. Basically, Binance is operating an international crypto exchange, which to the CFTC looks like a commodities exchange, and they're unregistered in the United States, and they are coaching their U.S.-based customers, many of whom are sophisticated hedge funds and prop trading firms, coaching them on how to thwart their own internal controls that are supposed to stop U.S. firms from. So they're teaching them to use dummy IP addresses and log in using VPNs and change the name of the account or register accounts in foreign places like the island of Jersey or the Caymans. The whole thing is super gross, and they have emails and text messages. Like I don't even know what there's an argument about. Putting aside whether or not these tokens or coins are commodities or not, you're operating an exchange and you're helping people get around the rules. Mm-hmm. And they got you.
I wonder if the CFTC, SEC is like a CIA, FBI thing. Like, are they like competing to like?
Well, so that's
to regulate.
That's what was interesting. This is a Fox News reporter, and Eleanor Terrett. John, put this up. According to sources familiar, the CFTC lawsuit was dropped on Binance without warning, similar to Coinbase's Wells notice. Some industry professionals believe this was a political move by the CFTC to show the SEC that this is a commodities issue rather than a securities one. They also say Vegas odds have the SEC rushing out a similar lawsuit against Binance as a counter, to which I would say, gentlemen, ladies, let's not fight. There's plenty of money that everyone could find this company for.
But
take
Josh,
all of it.
To that point, the CFTC does not have authority to levy criminal charges. It's only going to be civil. So Binance will pay $500 million and move on. Whatever it is.
Let me help you out here. The CFTC is well within its authority to refer this to justice.
What are you, a fucking criminal expert? What are you talking about?
Or any other body that they feel should be prosecuting.
Are you an attorney,
this.
sir?
I am not. I'm not.
So let me help you out here. I have nothing to follow that with, but
well, the CFTC is not going to be like, pay us a fine, and it's cool about the crime. We won't tell anyone. They'll turn over all of their files immediately to law enforcement because that's part of our system. You don't just get to pay a fine when you do a crime. You actually, if you're found,
sometimes you do.
Well, if you get away with it.
Actually, that's exactly what happens. You do pay a fine, and then you move on.
For crimes, somebody goes away. Somebody goes away. At this level,
Not usually.
I think.
With that much money, no.
Here's a CZ quote. Give them a heads up to ensure they don't connect from a U.S. IP. Don't leave anything in writing, he wrote. They have non-U.S. entities. Let's also make sure we don't hit the biggest market makers with that email first. Do you have Signal? Everything about that. Signal is like the hit, secret communications.
Yeah, they got him.
They have big firms trading through them, or at least they did at the time. I wonder if there's any culpability on the side of like the trading firms themselves.
Oh, interesting. Were they breaking the laws by thwarting the laws? I don't know.
Can they trade on a non-registered exchange? Do they have the right to, if it exists? Maybe they shouldn't, but they have the legal right to. Anyway, this will be 12 or 16 years worth of lawsuits. Let's go to topic 6.
All right, this is gonna be a quick one. So
this is crazy.
I keep talking about like why is the market bullish, and people think that I'm bullish. I'm not. I'm just I'm just asking, how come the market is not going down? Like, what's happening? And maybe it's just as simple as people are just positioned for much worse than the news that we're getting. So Dietrich tweeted, with the S&P 500 up 2 weeks in a row in the face of terrible news and the NASDAQ 100 at a 7-month high, think about this. The most hated asset is U.S. stocks, while cash is the most loved. And then he has a great quote from Patton. If everybody is thinking alike, somebody isn't thinking. So I don't know how long.
Look at this.
I don't know how long this positioning can put a floor under U.S. stocks.
Hold on.
Forever, but this is it.
Hold on. What's FMS Investors?
Fund manager survey.
Okay, so these are the people they talk to all the time about what they're doing. So these are professional fund managers globally. They are now the most overweight cash and the most underweight U.S. equities as of March 23. And let's define what we mean. They are 40% overweight cash, and they are 45% underweight U.S. equities, according to the survey, which we all know is probably not exactly reality. I don't think sentiment-wise, that's crazy.
Yeah, I don't think like they're 40% overweight. I think it's the participants. 40% of participants are saying that they're overweight or underweight. I think that's how you interpret it.
It says it says absolute net percentage overweight
of respondents. I think it's of respondents.
Oh,
but either way, the point is that nobody's expecting. People are bearish.
Can I tell you a funny thought I had the other day? I might write something about this. I was thinking, like, anytime the market goes against what you think, or like you say this should happen and the other thing happens, just be like, oh, it's just positioning. Like, that's positioning is the new, like, totally. That's why I'm wrong and the market is right now. Positioning. But that's not fundamentals.
You're right. It's a catch-all. It's a catch-all for why things aren't doing what you say they're going to do. But how else do you explain the stock market not going down with fucking banks falling apart, the FDIC coming in, rates being hiked, and no anticipation of rate or no signaling of rate cuts? How do you explain stocks going up?
And
how else do you explain it?
Positioning.
There it is.
It's all positioning, Michael.
All right, I'm going to make the case for a stock. Shoot, I forgot to throw a chart in here. So we're talking about chart. There's several charts, but there's one that I forgot. The chart that I want to show was when you didn't make the case for SL Green, and I'll explain. In September of 2022, you put the stock in our radar, but credit to you. You said the stock looks like a falling knife. Oh, and it was a falling knife. I think it's been cut in half since you said that.
Still a falling knife.
Still a falling knife. I made the case that I was not with you. I was with you. I said it's a falling knife. I'm not touching it. Well, guess what? What I did today. I bought SL Green. Not a ton.
Fuck out of here.
Not a ton. I took my money
in the A account.
I took my money out of Google. I bought Google last week. I did the Homer Simpson in and out. I changed my mind on Google. And I put into SL Green. Listen, not a ton of money, so this is not life-changing. I put $5,000 in, okay? So that's what we're dealing with.
Oh, okay.
Just to get that out of the way. Okay. But here's the deal with SL Green. I'm gonna take you through some charts. I'm gonna tell you a story, and then we're gonna go from there. Cool? John, if you please. This chart is from their 2022 annual institutional investor conference. It very clearly shows 2019, shows the Manhattan investment market sales volume. I should mention, by the way, SL Green is a gigantic commercial landlord in New York City.
It's 25 office buildings in Manhattan, including
Class A.
one Vanderbilt and one Madison, two of the nicest office buildings in the world.
All the prime shit. And then in 2020, of course, we know what happened. That's the blue line. 2021, a little bit better. 2022, a little bit better, but still way below where it was in 2019.
Of course.
Next chart, please. This surprised the bejesus out of me. So we're looking at the office using jobs that were lost in the pandemic from February 2020 through June 2020, negative 161,000. Since that time, July 2020 through December 2022, they added 186,000. So more people in the office than pre-pandemic.
That's not what this says.
Not in the office. Office using jobs. I could.
Okay.
Okay.
We know office occupancy rates are about 60%.
Next chart. Not their offices. They're all in the 90s because they've got the hot shit.
Yeah.
All right. There's a proposal.
This is interesting. Wait. This is interesting. So one Vanderbilt is currently 99% occupied. Now, in the history of massive Class A real estate, you could not have picked a worse time to unveil a project than one Vanderbilt, which I think was open for 3 months before the pandemic. But somehow I guess they had leased enough of it prior to that, and they're okay there. That's very interesting to me. I didn't know that.
Okay, the next chart is there's a proposal out there. It's in conjunction with Jay-Z to build a Caesar's Palace, like a legit palace in Times Square. You know about this?
That's the worst idea I've ever heard.
Go on.
You know how disgusting it already is there?
Oh, I sure do. I totally do.
Now you're gonna add this shit?
I totally do.
They should build it and then and then implode the whole thing so it sinks into the Earth's core.
All right, forget about this. Here's the deal. The stock during the great financial crisis, it was in a 94% drawdown. Today, it's in an 82% drawdown. 82. Everybody knows that the shoe is going to drop.
It's in an 82% drawdown, but not even from pandemic, from prior to that.
From like 2018, from 2018 to today.
Yeah.
The market cap is like 1.6 billion. That's where it was in like 1998 or something. Just a massive round trip. However, the dividend looks healthy. Look at their history of dividends. Even in the great financial crisis, they paid their dividends. So this is probably unsustainable. In fact, I think they did say that they're going to lower their dividend because right now it's yielding 16%.
Well, they cut it in. They already cut the dividend in 22. They'll cut it again this year. Why would they pay it?
For sure. Shares outstanding. The company is shareholder friendly, but they're not stupid. They've stopped buying back stock, which is a good thing. People are rightly super bearish on the stock. If you look at the next chart, percentage of shares outstanding short. There's a lot of action betting against the company. I mean, a lot. I was listening to one of the earnings calls. Oh, this was at the conference. The city has a property conference that they did last month. Mark Holliday, the chairman and CEO, said, I'd also say office to resi conversion is a topic that's out there that people should keep their eyes on. People always said it's too political, it's too complicated, and they're not wrong, but there is so much momentum behind this effort to take secondary and tertiary office, expand the universe of what's eligible, blah, blah, blah. So
you need a New York State zoning change, and that could happen, but before they have their first dollar from apartment rent, you could be talking about 2 years.
Fair, totally. Okay. To the point, though, that like management knows. Management knows that the stock is an 82% drawdown.
I think they're like a very high quality, high class organization. It's not their fault.
So
they're just
to that
in
point,
a shitty situation.
Yeah. To that point, they laid out their saving strategies. Next chart, please. We don't need to go through all of this, but they know what the street wants to see. I like the fact that they gave themselves a pretty shitty review on the 2022 scorecard. They're not delusional. We don't need to get into all the details here, but management is all right. So here's the thing. Chart off. I just made a little bit of the fundamental case that things are probably going to get worse. In fact, they're almost definitely going to get worse. But is the market over anticipating how bad things are going to get? It's down 82%. That being said, this is as much a technical call as anything. Next chart, please. These are monthly candlesticks. And you see in the bottom
my
during
God.
the GFC, look at the volume puke.
Yeah.
And you're seeing that now. Just forced liquidation. The next chart is a weekly version of this. Again, look at the bottom red.
Where is that stock? Is that 20?
Yeah, look at all of that volume. This
Yeah.
is just forced selling. This is just margin calls. And then the next chart is the daily. And obviously you're seeing a tiny bit of green. It could still get cut in half from here. But I'm going to be in this thing. If it goes 40% lower, I'm going to buy more.
I would sell rips. I would sell rips though. Like if this thing goes to 23, I wouldn't like start convincing yourself. I bought the bottom in a long-term great hold.
No, listen,
I think it's gonna be a shitty 5 years for these companies.
There's massive headwinds, massive. And if it goes, if I get a quick rip to 30, I'll sell. I'm not selling at 23. Not interested in that.
Okay. Well done, sir. I like it. I think you did a pretty good job. I'll probably take a look at this. I just think I have all the time in the world and I'm not going to miss anything. I could be wrong.
I agree. Put it this way.
I agree that there will be an opportunity here.
There's not going to be a V-shaped recovery, and it might be a nasty long hog, but I want to bet on New York City.
All right. Who's ready for the mystery chart? You ready? My mystery chart of the day, and then we'll get out of here? Okay. Let's pop it.
What in the world?
Well, we spoke about it today.
Jeez Louise.
Come on. You can do this.
I want to
Think about what we talked about today.
All right, hold on. I'm going. No, I don't want to.
There wasn't a lot of good stuff today. There was a lot of negative stuff, but this is a bright spot.
Binance coin? No, I'm kidding. Give me a clue.
Okay. It's a financial stock.
Oh, okay. Oh, this is a financial stock?
It is.
What the hell?
All right. Reveal. First Citizens Bank shares, player. We had some people get it in the chat. Let's see.
That's great.
Who got in the chat? Rob Passarella. Shout to Rob. Greg Schultz.
This is a wild chart.
Yeah, some people got it. Not a lot. So that is, put that back up. This is like, you ever hear the phrase like kings will be made? This is an environment where a lot of people will lose, but a few people are going to win big. And this bank was ready. They were experienced at doing these rescues. They had proven themselves in the eyes of the FDIC. They were liquid. They were good to go, and they did it. And
I have to say, this is an amazing mystery chart. Credit to you. Before we get out of here, do you know what I'm about to do? We haven't spoken about this yet. I am about to cook a meal that was delivered to my home from Home Chef. I am a huge fan. Huge fan.
Are they paying us?
No. But just listen.
All right.
I don't know about you. Stop. I am sick and tired of getting La Piazza 4 times a week.
Yeah.
So I want to switch it up. They send you like it's all made for you. It's great. Huge fan.
What are you making?
Like a pear pizza or something. It's really good and it's not expensive.
A pear pizza. Okay.
Like pear and goat cheese maybe with some balsamic drizzle, I think.
Oh, okay. All right. Well, you'll let us know. You'll let us know at the end of the week on our next podcast how it went. Hey guys, thanks so much for watching. We really appreciate it. Shout out to everyone who came for the live. Make sure you subscribe. Make sure you hit that like button. We will be back with a new Animal Spirits tomorrow morning, Michael and Ben, and then a brand new Compound and Friends at the end of the week with a very special guest. We're so excited, and we will see you then. Thanks, guys. Good night.